Volatility is really what financial people call risk, and risk is just those squiggles that you see on a chart, so it's how much something goes up and down. Volatility is a big fear for most investors, but that's just because that's the way our brains are wired. Today, we're going to find out how volatility can be used for good to help people that are saving for their futures. This is Mark Perspectives, and today we're looking at volatility as a saver's best friend. I'm Cam Irvin, advisor and lifestyle financial planner, and this is brought to you by Irvin Wenborn. If you're drawing off your money, volatility is a bigger problem because you don't want to be in a position where you need to make a withdrawal when your portfolio has dropped and lost $100,000. That's uncomfortable. But that's for people who are taking money out of their portfolios. So what about people who are putting money in or contributing? Well, it's a little different. Let's take a look at an example. We have Tina and Nicole, and both of them are investing some savings that they've earned. They're starting with $10,000, but also contributing $2,000 a month on top of that into red herring investment over a period of 20 years. Tina's first 3 years of returns look like this: positive 37.5%, 23%, 33%. Meanwhile, Nicole's situation looks a little bit different. Nicole's first 3 years of returns are negative 9%, negative 12%, and negative 22%. But those are just the first 3 years out of 20 in total, so we don't want to be too bogged down by the short term. Although when we look at the 20-year average for Tina, it comes in at 9.77% on average over that 20-year span, while Nicole's is 5.97%. So who would you rather be in this situation, Nicole or Tina? It's obvious, right? So here are the final numbers. Tina would have a whopping $1,188,096. And Nicole would only have a measly, tiny, pathetic $1,421,920? So Nicole wins? Wait, what? That can't be right. Let me double check that. Yeah, no, that's right. Nicole had $233,824 more than Tina by the end of the 20 years. Now you might be thinking, Cam, what kind of voodoo or magic are you trying to pull here? And my answer would be maths. These returns are not based on red herring investment, in case that wasn't clear, but it's actually based on the S&P 500, just from different years. Tina's returns are from the years of 1995 to 2014, which was a sweet time to be investing, while Nicole's started during the tech bubble, so from 2000 to 2019. Not so good. So looking at that in a little bit more depth, here's how it happens. Nicole invested her $10,000 just the same as Tina did, right at the beginning. But the difference is, Nicole's investment went down right away, but she was making monthly contributions of $2,000, so that would top up the balance afterwards. So after a decline would go up, then the balance would go down again, she would top up her contribution, it would go down again, and then she'd continue to top it up, and so that cycle would continue. So in practice, what actually ended up happening is her balance really never dropped too much. We can see it listed here as year 1, 2, and then 3. You'll notice that the balance really only heads one direction, which is up. Now, quick note, on a shorter time scale, yes, her balance would have gone down. So if Nicole checked her balance on a weekly or daily basis, there would have been times that it was negative or lower than the day or week prior. However, because this time scale is looking at things on an annual basis, it's much more grand scheme. And because of that, it smooths out the returns so that you can see things are more stable and tend to go more one direction. If we zoom out even more, looking at the 20 years, our first 3 years are just listed here in the highlight, but the balance clearly goes mostly one direction until it eventually ends at the $1.4 million balance, and comparing that to Tina's money, which went in and topped out at a little less than $1.2 million. The way that all of this is possible is really just coming down to when you buy something or you make a purchase, you want to get the lowest price that you possibly can as a buyer. And investing money is no different because you're essentially investing or buying part of a company. That's what the share represents. When the investments go down, it actually means that we're buying more of that investment. So if you put in $2,000 a month, now your money's going farther. It's like buying a sale on the investments. Just think of it this way, all else equal, would you rather buy the same house for $1 million or $800,000? It's pretty clear. If you're buying something, you want to get it for as cheap as possible. And volatility gives the option for savers to do that. You're buying in at the high points, but also at the low points. And that's exactly what takes place here with Nicole and Tina. Nicole is taking advantage of the volatility, and even though the investment itself, the S&P 500, had a lower return for the time that she was investing her money, she, as the investor, actually came out better off. That's the beauty of the volatility. So for anybody that's looking to save money and isn't yet nearing the point when they need to draw off of their money, seeking out volatility and being comfortable with risk just means more opportunity and more growth for you over that long term. Assuming that you can stick to the plan and stay invested, it doesn't work so well if we get spooked and then decide to stop contributing money after a while. So the takeaways from this today are, number 1, if you're saving and investing, volatility is your friend. No need to be afraid of that. Number 2, when investment and share markets go down, that's a sale. So that's actually the best time to invest. It's not a time to be pulling away. Finally, number 3, aiming for the highest possible return isn't as important as you might think it is if you're drip feeding your money in over time. It's better to have a good process than seeking out the single best investment for a short time period. If you enjoyed this video, reach out. You can always find us at our home on the web at irvinwenborn.co.nz, email, LinkedIn, or subscribe to this channel. You can also share this video with someone else that you think might benefit from the information, or if you just enjoy a good debate.